Hey everybody, this is Colin podcasting about real estate and welcome to show 19. My guest today is Keith Weinhold. Anybody that listens to other real estate podcasts might know him from the Get Rich Education show. I've known Keith for about 4 years. He's bought some properties from me in Tampa. He's a very successful investor on his own right. He's been buying apartments and single family homes since about 2002. But he's also a best-selling author. He's a writer with Forbes. He's got a very successful podcast, a successful website, and he's just a very pretty original thinker, and he speaks very, very clearly about real estate. So it's always good to get a chance to talk to him, and we spoke about, both about some of the basics about, why people invest in real estate, the 5 ways you get paid from real estate, which I'll bet a lot of you, might not have thought quite this way about how you get paid from real estate before. So it's worth listening just for that. We talk about the traits that separate poor people from middle class people, from wealthy people. We talk about where successful investors are buying throughout the United States in Q3 and Q4 2020. We talk about his thoughts on the whole 2020 crazy year and what's ahead for inventory. We talk about shadow inventory and shadow demand, which could be coming at us. That was interesting as well. So just a good show. We covered a lot of ground and I think you're going to enjoy it. I certainly enjoyed speaking with him. And, before we head on over to Keith, do remember that I have a website, colininvestments.com, that you guys can check out for videos, podcasts, reports, or just to schedule a quick 15-20 minute call with me to tell me about your own real estate journey. And if I can help you accelerate it with a few hints and tips, I'll be very happy to do so, or introduce you to someone that can. And you'll find me on social media. I'm on Facebook, Twitter, Instagram, on either Colin G. Murphy or Colin Investment or Investment. So you'll find me there. All those links are on the website as well. But this is a good show, episode 19 with Keith Weinhold. It's a good one. I think you're going to enjoy it. So let's head on over and meet Keith Weinhold. Keith Weinhold, how are you doing? Welcome to the show. It's great to have you.
Hey, fantastic. It's an honor. Thanks for having me, Colin.
Not at all. Not at all. I know I've had the honor of being on your show once or twice, and we've spoken before on these calls many times. But for those who don't know much about you, Keith, can you introduce yourself just a little bit briefly and tell us about your start in real estate?
Yeah, my name's Keith Weinhold. I own Get Rich Education, a real estate investing education company, and I live in sort of an unusual place, a place I dreamed of living one day, and I do live here now. That is beautiful and pristine Anchorage, Alaska.
Wow.
And you asked about the way that I started out, Colin. I started out with my first ever home of any kind being a fourplex building where I lived in one unit, rented out the other 3, and I didn't even know what terms like cash flow and equity meant until months after I had owned the building. So it was a little bit of start before you're ready there with that
Mm-hmm.
Midtown Anchorage, Alaska fourplex all those years ago.
Wow. And what year was this, to give us a little bit of context?
2002. So I started pretty young, and why would you do something like that if you don't even know what cash flow and equity mean? Some would say, well, don't you need a little bit of education before you get going? We could talk about that some more, really, Colin, but the short answer is, why did I do that, that early and that young? It's because I had 2 friends that weren't really real estate guys, but they had also started out buying a fourplex building with just an FHA 3.5% down payment, living in one unit and renting out the other 3 so that
Yeah.
they could do it. I kind of figured that I could do it too. It kind of goes along, Colin, with the well-known Jim Rohn quote, the famous
Mhm.
business philosopher: you are the average of the 5 people that you spend the most time with. So these 2 friends,
Yeah.
Chris and Raj, were in my hemisphere, and that's what positively influenced me.
That's awesome. And that's the perfect way to get started, a fourplex with that fantastic FHA loan. And it's the best way to do it. I mean, some people do it duplexes, triplexes. Some people do it with a single family home and rent out a bedroom. But if you can get started and get other people to help pay you that mortgage and then give yourself a place to live as well, that's perfect for any young person looking to start.
It's a great way to start with a bang, and a lot of people don't realize that program is still available today, and it's largely unchanged. So what we're talking about here, to be clear with your audience, Colin, is you being, an unqualified person. It doesn't take any degree or certification to get into real estate investing at all.
Hmm.
You can buy a single family home duplex, triplex, or fourplex. You probably know, Colin, a fourplex is the most number of doors you can use with this FHA loan program, where you
Hmm.
only need a minimum of a 3.5% down payment. You don't even need a high credit score, though if you have a better credit score, you will get a better interest rate. And the other criterion is that you need to live in one of the 4 units for at least 12 months to get what they call that owner-occupied financing. But
Hmm.
yeah, like you said, this is a real estate investment where you've also put a roof over your head. You're doing both at once. And as soon as you move out at the 12-month mark, or maybe it's even the 3-year mark, like I lived in that first fourplex for a little over 3 years, what you've done when you move out of that building and into another home is a couple things. Now you've created a fourth rent income from that
Yep.
building because you just vacated one of the units. So your rent income goes from 3 to 4. And now you can use all 4 of those rent incomes to qualify for a better single family home. You can use that as part of your income qualification for a better single family home than you ever could have bought had you just started out buying a single family home yourself, trying to qualify with your own income. So that's
Hmm.
buying a fourplex with what they call an owner occupied FHA loan. That is starting with a bang. That's how I started.
So, a young guy buying a fourplex in Anchorage. Did you tenant those yourself? Did you do anything funny or silly that you remember now?
Oh, yeah, you just learn all these terrible lessons. I'm not saying it is always easy. I'm saying
Hmm.
doing this is worth it. And I think that's what you're touching on,
Yeah.
Colin. I made a lot of the mistakes that, a young male would make. I remember when I had a vacancy in one of my units. Actually,
Hmm.
it was the unit right next to mine. This is a townhouse style fourplex. We all
Hmm.
live side by side in one contiguous attached building. The unit right next to me, these 3 attractive girls wanted to rent the unit next to mine. And,
Okay.
I'm busy. I'm still working a full-time job as a construction materials inspector. And, you just kind of have this temptation to want to get the vacancy filled and not
Yep.
check credit scores and think, wow, if these attractive girls are living right next to me, I mean, they're qualified. No, they weren't qualified. They partied so hard that the police had to show up. I didn't allow dogs in the building, and they tried to hide dogs on me, even though they lived in the unit next door. So it did
Uh-huh.
not go well, and it did not end well. So fourplex building isn't always easy. It's worth it. But yeah, of course, one has got to keep in mind that, oh, now they're a landlord. And when you're a landlord and you live on site, there are pros and cons. The pros are you can respond to problems quickly and easily. And the
Yep.
cons are if you have a tenant that's a little bit picky and touchy-feely, they might be passing you on the sidewalk a lot and saying, oh, hey, these little cabinet screws are loose again in my kitchen. Can you stop by and take a look at
Yeah.
that? Then when you do, it's like, oh, and while you're here, can you look at this? So there are pros and cons of having that owner-occupied fourplex, but it's a great way to start if you're geared that way.
It is. I own a fourplex a little bit like that, a contiguous building in Middletown, Ohio. And I remember that thing you're saying about the pets last time I was in there to look at them. You're just walking through and you open the little bathroom and say, oh, there's a cat in there. just in the bathroom with the door closed. Isn't that funny? They just like hide all the animals just before the inspection, thinking you're not going to spot them, but people generally do. They've seen all these tricks before. So but I like what you said about the going from the third income stream to the fourth income stream, and it's
Yeah.
just great. Most people have one income stream, and adding another 4 is great. And when people think of rentals, they're thinking, "Yeah, I'm going to get some rental income. I might get some appreciation." But there's a little bit more to real estate than that. I know you're very well known, Keith, for talking about the 5 ways you can get paid through real estate. Can you elaborate on that a little bit for us?
Yeah, please let me do that. Most investors come from this mindset of, well, you've got to buy low, like with a stock or a mutual fund, and
Hmm.
sell high. And that difference being your capital gain, that is your profit. And buying low and selling high sounds easy, but it's more difficult to do than it is, right? It's very tempting for people to buy high because the momentum has run up the market so much. And it's very easy to sell low because after a stock has dropped, you get emotion behind it and you're just so discouraged and you just want to get out because you justify that
Yep.
you can stop the bleeding. But with real estate, yeah, like I said, Colin, real estate investors are typically paid 5 ways at the same time when they buy residential property, much like I did with that first fourplex building where I used a small down payment. The first of 5 ways, one is typically paid just over the long term and in general is with appreciation. 6% is the long-term appreciation rate per the NAR. I think they have it at 6.4%. We'll just call it
Hmm.
6. The second way is that cash flow, that income stream. So when you buy a property, you should buy it where the projected monthly rent income should exceed all of the monthly expenses. The typical monthly expenses are mortgage principal, mortgage interest, a factor for vacancy, insurance, maintenance, property tax, utilities, and management.
Mm-hmm.
That is your monthly cash flow. And then the third way is what I call your ROA, your return on amortization. See, real estate has both ROIs and an ROA, and your return on amortization is that portion of the principal balance that the tenant pays down for you every month on the loan on your rental property. And you know what's interesting, Colin, is a lot of people that have experience with owning their own home say, oh, well, I already have experience with this because I pay down the principal in my own home. But no, this is different. In your own home, you had to earn that money at the end of every month that goes toward paying part interest and part principal. But in this case, the tenant pays down both the principal and the interest for you. You didn't have to earn any of that money in a cash flowing rental. So that's your ROA, your return on amortization, which would be the amount of principal that they pay down for you annually divided by your skin in the game or your down payment. That's your
Mm-hmm.
ROA formula. And then fourthly are this big bevy of tax advantages. And this kind of gets nuanced and complex, so we're not going to get into it all, but it's a basket of advantages like tax depreciation, which means you don't have to pay tax on a portion of your rent income, and the mortgage interest deduction, and something that I've used a few times in my life called a 1031 tax deferred exchange. And the short
Mm-hmm.
story is there that you don't even have to pay tax on your capital gain portion. I've legally never paid capital gains tax in my entire life on my real estate because I structure things correctly with a 1031 exchange. So tax benefits, which are just fantastic, and you can get them at scale when you own a number of properties. That is
Yeah.
the fourth of 5 ways you're paid. And then the fifth of 5 ways that one is typically paid is probably the least understood way, Colin. That is inflation profiting. And I run into real estate investors all the time, even experienced real estate investors, even millionaire and billionaire real estate investors that don't understand inflation profiting. Most people's experience with inflation is really something they think about at the consumer level, where your burrito at Qdoba or Chipotle costs $11 this year, and you know it cost $10 with the same size and the same ingredients a few years ago. But conversely, when you're a borrower rather than a saver, because
Mm-hmm.
inflation diminishes your savings, but oppositely, when you're a borrower, say you're a real estate investor that borrows $1 million, at a 3% inflation rate, after year one, you only owe the bank back $970K. And in year two, you only owe the bank back $940K. And in year three, you only owe the bank back $910K in real inflation adjusted dollars. And some people are like, well, wait, what about the interest you pay on the loan? Like, doesn't that factor in? No, not actually, because in a cash flowing rental, the tenant pays the interest for you. So it's inflation profiting when you're a debtor. And I got to say, debt is my favorite 4-letter word. Debt is a good word when you have smart debt because the debt is outsourced to tenants. That's my definition of smart debt in real estate, when it's outsourced to tenants. And you can do that at scale when you profit from inflation. So those are the 5 ways: appreciation, cash flow, your ROA, your return on amortization.
Mm-hmm.
Fourthly is the taxes, and then finally is that inflation profiting benefit that's really stealth that a lot of people don't think about.
I love it. I love it. And it just goes to show, if you think of real estate as a long-term game, a long-term get rich slow game, those, that fourth and fifth one are crucial. And if you just have two guys and one earns $60,000 with a W-2 job and the other earns $60,000 from rental income, if they both have good CPAs, I guarantee you there's going to be a dramatic difference in their take-home pay. The guy that earns 60,000 from real estate is going to pay a lot less taxes than the person who's going through a normal payroll.
Yeah, that's a good point. And the tax benefit, like you mentioned, is something you're really only going to feel annually when you get your tax return. And then there's
Mm-hmm.
other profit centers like the cash flow, which is something that's very liquid because you feel that one monthly. But yeah, you talked about it being a long-term game. Some of these profit centers are so stealth, like the inflation hedging. I owned a single-family rental home, for example. Actually, it's in your home state of Florida, where I just got a bill for $1,200. It has something to do with
Mm-hmm.
upgrading an electrical problem. See, I see that $1,200 invoice. That hurts, that stings a little bit. Oh, I just
Yep.
opened my email and I'm $1,200 poor because I've opened that email. But the thing that people don't see is something like that slow rate of appreciation or that inflation profiting. Again, if you got $2 million of debt at a 3% inflation rate, you've got a 60K tailwind, 60K of prosperity benefit every year that you don't see on an invoice like I do for that $1,200 electrical invoice bill that I didn't expect that I was getting. So you got to consider these stealth things with
Yeah.
all those profit centers in real estate.
You do. People think of $1,200 and they might just think that's 4 months of net rental income, but you're not really thinking, well, how much mortgage principal have you paid down since you bought it? Or has the tenant paid down? How much has the value of your property changed? And how much taxes am I saving for owning this property? So you're right, there's loads of things. And I guess that brings us on to this next topic. I mean, there's a lot of wealth been generated in the last kind of 6, 9 months, and a lot of people talk about this big divide between the haves and the have-nots, and
Yeah.
that's a pretty fair observation. But I want to ask you in a different way about what are the key habits and traits that you see that differentiate, poor people from middle class people from wealthy people?
Oh, that's a great question. I mean, there are a lot of ways you can parse something like this, right? What mindset differentiates the poor, the middle class, and the wealthy? The
Mm-hmm.
poor, hey, they might provide value to society. Maybe they're your custodian or your Uber driver or someone like that. But these people don't really have any money left over. They're living paycheck to paycheck. We'll call them poor. The middle class, they might be a professional, say a licensed professional engineer. And the middle
Mm-hmm.
class, they often have some money left over, some investment. Oftentimes they might put them in a 401k. They might put those funds in an IRA. And oftentimes that middle class worker that's really into being a professional hydraulic engineer or whatever they're doing, their
Yep.
mind is in their work, and that's okay. They're providing benefit there, but they have some money left over. They're getting some of their dollars to work for them. The poor aren't. The poor are working for all their money. The middle class are also working for money, but they get some of their dollars to work for them. But the problem is that engineer thinks that what could be better than getting some of my dollars to work for me? And the short answer is you're not getting other people's money to work for you. That's what
Mm-hmm.
the wealthy do. And that's what everyday people can do even before they're wealthy as a real estate investor. Just like I did with that first fourplex building, you can ethically use other people's money 3 ways at the same time with no degree or certification. The first way is use the tenant's money for the income stream, the cash flow. The
Mm-hmm.
second way is use the bank's money for the leverage and the loan. And the return that you get on that portion that you borrowed from the bank is yours, not the bank's. That's financial leverage. And then the third way you ethically use other people's money, not only your own, is with the government's money for those very generous tax incentives, like I mentioned earlier. So that's really the short story. That is what can make a person wealthy instead of poor. This can stop people in their tracks. Don't just get your money to work for you. Use your money to leverage other people's money, and you can do it 3 ways at the same time with leveraged cash flow and real estate like we're talking about here. That's huge. That's the mindset shift.
I love it. I love it. I think that's very, very relevant. And look, but the reality of today's real estate market is that it's a hyper competitive market. Inventory is
Yeah.
really low. There's a lot of competition, a lot of bidding wars out there. I mean, what tips do you have for investors or even home buyers that want to come out on top in a bidding war, whether that's for their own personal residence or whether that's to add a couple of rentals to their portfolio?
Oh, that's a great point because there are more bidding wars since inventory is so short. Just like most anything in economics, real estate is a supply and demand game. We're about
Mm-hmm.
2.5 million housing units undersupplied in the
Wow.
United States. So demand exceeds supply. So that's what can lead to some of these bidding wars and why we're continuing to see upward price appreciation. A great way to win a bidding war that's so simple is really if you're interested in a property, whether that's a primary residence for yourself or a rental property, just simply ask the seller what they would need to have an offer accepted today. So the best way to win a bidding war is just to avoid having a bidding war. And that's so simple rather than trying to guess or position yourself, or maybe you'll end up offering too much. Maybe your seller actually would accept less than what you'd be willing to pay. So just let them know that you're serious. Let them know that you're a qualified buyer. Maybe even show them earnest money as early as you possibly can. But simply ask, what would it take to get an offer accepted today? Now, if you're already in a situation where you're in a bidding war, a great way to stay on top of it, whether using a buyer agent or not, is for you to write 3 different offers, each one higher than the other. Give all 3 offers to your buyer agent and have them go ahead and give the lowest offer to the seller agent. And if that offer is not acceptable, therefore that buyer agent already has that second and third offer from you. They can stay on top of a bidding war and they can put that higher offer right on top of the previous one. So that's a good way to ladder things, to
Yep.
minimize your risk with how much you might have to pay out of pocket. But at the same time, you're not waiting to get answers back and forth, because that can be slow, frustrating, and time consuming. So write multiple offers at the same time if you think you're already in a bidding war situation. So those are strategies for how to avoid a bidding war. And if you're in one, how to stay on top of one.
Think so. And I would just add that just put a generous earnest money deposit, because if you're getting an inspection period, it's refundable anyway. It doesn't really cost you much to put $10,000 earnest money instead of $5,000 earnest money or $2,000 earnest money. But the seller sees more dollar signs in their eyes when they see a big earnest money deposit. And you could have a shorter inspection period. A lot of people just want 15-day inspection periods. You don't necessarily need that. If you have a property inspector on your list of phone contacts, and you can generally get them out there within 3 or 4 days. That's another way of doing it. And I guess just being quick, just being on it, and getting, like you say, getting on the phone to them quickly, getting offers submitted quickly. It's not always the highest offer that gets accepted. It's often the person that builds that quick rapport and fires in that quick offer with other little terms and conditions like inspection periods, earnest money deposits, quicker closing dates, things like that. There's a lot you can do.
You bring up a lot of good points. Yeah, with elevating the amount of earnest money, it helps to show that prospective seller that you are serious. I mean, it goes without saying, really, that if you're going to get a mortgage, you obviously want to be pre-approved already. We're going beyond those sorts of things here. Of course, you can just offer substantially more in your purchase price if you want to as well. But now, of course, that begins to put pressure on the appraisal. If you're using financing, then the appraisal needs to come in at that value if you've offered to buy it for more than the purchase price, and you might need to be ready to make up that shortfall if the appraisal comes in below what you've offered. But yeah, a way around that without putting pressure on the appraisal is to, yes, indeed, offer more earnest money.
Okay, good tips in there. So let's kind of pivot slightly. So, talking about real estate is getting super busy. I mean, you interact with a lot of investors, you interact with a lot of people that sell real estate. What property types and locations are you seeing successful investors buying in this year? Because it changes every 3 or 4 years. There's like a little change in the wind, and people start pivoting. What are you seeing now?
Yeah, that's a great point. For example, 3 or 4 years ago, Texas was really one of the hottest markets to buy in for
Mm,
cash flow, and they still have strong economies in most Texas MSAs. But things have changed in the past 5 years, where purchase prices of Texas property have run up faster than rents could keep up with proportionally. So
mm-hmm,
therefore, if you're looking for cash flow, I mean, it depends on one's objectives as an investor. Other markets begin to make more sense. Memphis, Tennessee has great ratios of rent income to purchase price. A lot of times in Memphis, you're not going to get as much appreciation as you will in other markets.
sure.
I, Colin, very much like and have been doing my recent buying myself in the state where you reside, Florida, including the Tampa MSA that you're in and buying property there. You still get ratios of rent income to purchase price that make sense for an investor. And a lot of times that's something like you can get a rent income 0.8% per month as a
Mm-hmm,
proportion of what the property purchase price is. So for example, on a 100K property, $800 of monthly rent income, those numbers usually work for an investor that's putting 20% down and taking out an $80,000 loan. The
mm-hmm.
numbers still work there. And of course, some of those bigger picture dynamics really work in Florida well. As we know, demographically, in-migration has substantially exceeded out-migration in Florida
Oh
for a
yeah.
long time. People are attracted
Mm-hmm.
there for the good weather and no state income tax and all those reasons that you know about. So Florida has been a particular focus to me, Colin, and there's really 3 MSAs that work there: Jacksonville, Greater Orlando, and then the areas just outside the Tampa St. Pete MSA.
That's right. Okay, I agree with you. I'm also seeing, and you're probably seeing it more than me, a lot of people are now looking at new build. I've seen people looking at it in Florida, and the kind of thinking seems to be, well, if you can't get inventory for these 30, 40-year-old homes, maybe you can build one. And I think some builders seem to have been able to build houses that makes sense cash flow wise. That wasn't necessarily the case 4 or 5 years ago, but maybe it is now. Are you seeing that in Florida and other places?
Yeah, a number of places in Florida, they're still not really bringing on enough inventory nationally, but in Florida, I am seeing more new construction builds in each of those three MSAs that I mentioned previously.
Mm-hmm.
About 10 years ago, it really didn't pencil to make new build properties. 10 to 12
No.
years ago, we were still coming out of the Great Recession from 2007 to 2010. And in fact, real estate values had gone so incomprehensibly low then that you could often buy an existing property for less than the replacement cost of the property. So when you
Oh
can
yeah.
buy property for less than the cost to build it, they're not going to build any property. That's a big reason why we're in a supply shortfall today. There hasn't been enough new construction built. And when builders did begin building 5, 8 years ago, they were building higher priced homes. So there's
True.
really a dearth of inventory that's new construction in lower priced homes under 250K. So builders are starting to go there because the demand is beginning to pick up there. We're really undersupplied. And the pandemic has also made for greater demand for single family homes. So new build single family homes is potentially a good place to invest, really in a place like Florida.
I agree, and I have seen builders going into kind of middle class or more affordable homes, and it's understandable that they haven't in the past because, proportionately speaking, you can make more money building a 300 or $500,000 home than a
Yeah.
100 or $200,000 home. There's still a lot of labor and man hours involved in both, and the higher sales price generally results in a higher amount of profit in your back pocket as long as somebody's going to buy it. So I can see why they're going into the lower middle class stuff now because there's a lot of pent up demand, but it's just been such a strange year, Keith. So, I mean, when the pandemic kind of caused the economy to lock down back in kind of March, people were thinking we're heading right back to the Great Recession and maybe even worse because there's so many millions of people put out of work and a lot of builders and other people were worried about the future of real estate. But I certainly didn't. I don't think too many of us thought, fast forward to October, that stock and real estate prices will be at record highs. I mean, what's your take on how things have panned out and how do you think what's your crystal ball telling you about what's coming ahead in 2021?
Gosh, where to even begin, Colin? Like,
Oh, I know.
tell me if you agree with me here. I'm sure a lot of your audience would agree too. 2020 has been the strangest year of my life.
Yeah.
I mean, people wearing masks everywhere that you go. The fact that the government has actually engineered a recession. Now, whether you agree with that or not, it's just unusual. If someone would have told you a year ago that your government, no matter what country you live in, is going to engineer a recession, you would have a hard time believing that. But that's
Yeah.
where we are. So, yeah, I think originally a lot of asset investors in real estate and stocks, they didn't really know what a pandemic was going to mean for the markets. And when there's uncertainty, that usually makes markets go down. And there was some uncertainty, including a stock market dip right around the time that we
Sure.
had some of the COVID induced shutdowns. Because no one alive, for all intents and purposes, really has ever experienced anything like this. 1918 was when the Spanish flu took place. I mean, that was the last substantial pandemic to affect America and much of the world. So,
Mhm.
what's happened with real estate, especially for single family homes, is that the demand has surged. And it hasn't been quite that way with communal apartments because in a pandemic, I would know, I own both apartments and single family homes. In a pandemic, in apartments, people don't feel so good about sharing the same common area railings and
Yeah.
staircases and storage areas and sharing a laundry room with a bunch of families where you don't know what those other families' habits are during the week or if they're washing their hands or wearing masks or anything like that. So, this has really created this de-densification or re-ruralification, if you will, where people want to get out and they want to get their space. And that's why there's so much demand, for example, for a single family home detached on a 1/4 acre lot. People want that distancing. You ask about the crystal ball and what's coming next. Of course, no one really knows for sure. I mean, a year ago, no one would have believed that we are where we are now in this
Yeah.
strong recession where you've got to feel for people. I mean, there are still a lot of people that have lost their jobs and are unemployed, and they're really dealing with a lot of uncertainty. So, of course, I know you'd agree we're pretty privilege right now to even talk
Yes.
about, where should we shift our money or anything like that. Um, but what you're seeing is really a good bit of, I think you're seeing shadow inventory, which is a bad thing for real estate investors.
Mm-hmm.
And you're seeing shadow demand start to crop up as well, which is a good thing for real estate investors. I can tell you more about shadow inventory and shadow demand that's both each of which are being pent up in the pandemic, if you're interested.
But talk to us about that shadow inventory. I mean, because inventory is so low. Where do you see, where's this kind of hidden inventory coming from, or what might be coming at us?
Yeah, well, we're looking at a crystal ball, so I sure don't
Sure.
know that this is going to come true. But the shadow inventory could potentially happen is because we have a forbearance freeze, and
Yeah.
right now many people in the United States that can't pay their mortgages have something called forbearance. They have protection for being foreclosed upon by their bank until the end of the year, and it might get extended past that. But you really do have a growing number of people in America that have lost their job and can still not make their mortgage payments, but the bank can't come in and kick them out. So they're falling several mortgage payments behind. It's likely that some of them aren't going to be able to catch up when they are allowed to be foreclosed upon by the bank. So you could very well see some of this supply shortage not get so bad and so chronic and have a few more homes open up if
Yeah.
indeed, unfortunately, some of these homeowners lose their homes. So that's why I call that the shadow inventory. And then the shadow demand, this is something that very few people talk about. In fact, right now in the year 2020, we have
Mm-hmm.
more people ages 18 to 28 living at home with their parents than at any time since the Great Depression of the 1930s. So you
No
have
kidding.
all these young people living at home, a lot of young people that might have worked in service jobs that were laid off that
Right.
now live with their parents. Well, a lot of these people are millennial age, and some of the
Mm-hmm.
older Gen Zers, that's really creating pent up demand. People don't want to live with their parents when they get to be 26 and 28 and 30. So when the situation normalizes and we get control of the virus, when we get control there, that's when the economy can begin to normalize. And this is creating that pent up demand for all that household formation because you have all these people living at home. So, really, to summarize, you have
Mm-hmm.
potential shadow inventory meeting potential shadow demand, but we're already in a market again where demand for housing exceeds supply. So therefore, I think you have pretty good support for housing prices going ahead for these reasons.
Yeah, I would tend to agree with you. I definitely think you're going to see more supply of distressed homes coming on the market just because of the increase in
Yeah,
evictions and foreclosures. That's inevitable. But on the other hand, I think the market's going to be able to absorb it. I mean, minus another terrible second wave with another, huge lockdowns or whatever. But
yeah.
as things stand, the market can absolutely absorb a surge in foreclosures or evictions or anything else. And so it could be a while if people are there waiting for the big drop or waiting for an opportunity to fire in lowball offers like I was doing back in 2011, 12, 13, 14. I mean, you could be waiting a while, but just look at the fundamentals like Keith talks about. Look at those 5 ways you get paid, and if a deal makes sense and you can lock in those low interest rates, don't be hiding under your bed. Just keep going, keep adding those income streams, right?
Yeah, and I'm glad that you bring it back to the 5 ways you're paid because a lot of investors, they think of things like, now, is it time for me to be offensive with my money? Or is this a better time for me to go on defense? Well, when you're paid up to 5 ways, you can do both simultaneously. What if your tenant has trouble paying rent and some of your cash flow evaporates? Well, chances are good you still have appreciation. They still paid down some of the loan for you. You still have the tax benefits. You still have the inflation profiting on the long-term fixed interest rate debt, for example. So make your money do multiple jobs. That's what you could do with real estate. And you don't have to worry about these seasons as far as being on offense or being on defense. Just learn how to play a game worth winning, like cash flow in real estate, and learn how to do that well.
Love it. That's a great way of thinking about it. And it's just those little mindset shifts can make all the difference to your financial future implemented over many, many years. And I know you talk about this stuff and many other things in your podcast, Keith. It's a well-known podcast. You want to talk to us a little bit about it and the kind of guests you have on it?
Oh, yeah, thanks. It's the Get Rich Education podcast. Colin, you've been on the show a couple times. I know you've listened to a number of episodes. It actually is the most significant thing I've ever done in my life. I mean, to have more than 3 million listener downloads from publishing
Wow.
episodes for more than 6 years now, it's really the most significant thing I've ever done. I like to think that we talk about real estate investing more clearly than perhaps anywhere else you've ever heard about, and how it can make ordinary people wealthy. It all starts with thinking differently. And really, if you follow any, business leader, they've probably been on the show with me. Robert Kiyosaki's been on the show with me 3 times. He's come alongside me and we've discussed cash flow in real estate. Grant Cardone, Jim Rogers, Jim Rickards, most everyone that you follow, I've had here on the show. So yeah, I'd really love to have you as a listener. If you like to hear about real estate investing and how it makes ordinary people wealthy, that's at the Get Rich Education podcast and getricheducation.com.
Okay, well, I'll definitely put those show notes in there. And I mean, just very briefly, Keith, I mean, can a lot of people, maybe some people listening are starting their own podcast or they're trying to build something into something big. I mean, you didn't do your first episode and suddenly have Robert Kiyosaki saying, can I be on show two? Can you talk to us a little bit about that journey, how, and just give a little bit of encouragement to people out there that, want to kind of pursue something similar or something that some big dream like that?
Yeah, that's a good point. I began the Get Rich Education podcast with a $60 USB microphone plugged
Mm-hmm.
into the side of a laptop on my Anchorage, Alaska dining room table. I went from 0 to over 3 million listeners. It really starts with 3 key things. Speak clearly. People are busy enough. If you confuse them, they're going to tune out. Speak with authority. They want to hear from someone that has experience and has actually done these things and is doing what they're saying. And I think the third thing is keep showing up every week. I published every week without fail more than 300 episodes. If I didn't put an episode out there and I weren't there for somebody, they might go listen to someone else's show and get hooked on that. So, be of great value to people. I started off the first 6 episodes with no guests. It was 6 monologues. I want people to understand truly from me to them that real estate's changed my life in this way. Here's how it really can do it for you. But before I had any guests on. So it really starts about being a lead with giving thing. If you've ever thought about starting your own platform or blog or YouTube channel or podcast, it's a lead with giving sort of thing. You've got to give before anything comes back to you. And then you will grow an audience and you will have commercial sponsors that come on because they want to have this audience opened up to them. And now when you have a big audience and you have some commercial sponsors, it makes it pretty easy to land a Robert Kiyosaki or a Grant Cardone, but it starts with giving.
That's brilliant. That's great advice. I think that's a really nice way to wind up the show. So getricheducation.com, Get Rich Education Podcast. Any other places your audience should reach out to learn more about you, Keith?
A great thing to do is go to getricheducation.com/letter. That's where you can get my free ebook and our valuable Don't Quit Your Daydream email letter that's so valuable that you can't believe you ever missed out on or didn't know these things. So that's at getricheducation.com/letter.
Brilliant. Well, I've really enjoyed this conversation, Keith. I appreciate your time and let's stay in touch through these interesting times and see what's ahead for us.
Colin, I loved our chat. Thanks so much for having me on the show.
So there you go, folks. That was Keith Weinhold on Colin Podcast about Real Estate Show 19. I hope you enjoyed that chat. I certainly did. I think he's got a lot of wisdom. He's got a lot of experience. He's spoken with and interviewed a lot of the big guys in real estate investing, Robert Kiyosaki, Grant Cardone, loads of other people. You'll find them on his podcast. And, if I could just summarize a couple of things that stuck out at me, about that conversation, is just, number one, never underestimate the importance of goal setting and just aligning your actions and habits around those goals and around the people you hang out with. It's just so easy to get distracted, but we learn again and again that to be successful, you need some focus and you need to be disciplined. Another thing is that when you're analyzing and comparing deals, just try and think in terms of the 5 ways you get paid. Like Keith said, you get paid by appreciation, cash flow, loan pay down, tax benefits, inflation hedge. They're all very relevant. And I think you should kind of consider that when you're looking at deals, and obviously just practice looking at deals. If you want to buy property and you're not analyzing deals all the time in the evenings, you're minimizing your chances of getting ahead. You just have to develop those new habits, and you have to build those deal analyzing muscles. And I'm happy to help with that. If people want to schedule a call with me and ask me about how I analyze deals, I'll talk about that. Maybe I'll record a show on it some other time. Third thing, with this whole, COVID going on, and there's so much uncertainty, it's very tempting to sit on the sidelines. But, if you've got those reserves, if you've got a steady income stream coming in, I really don't think there is any need to sit on the sidelines now. I mean, you could have been forgiven for doing it, and I was guilty of it back in kind of March, April, early May. But, since then I've been a lot more active. And look, if you want to build wealth, you need to create a path, you need to build a team, you need to take action, and you need to gain experience. I mean, you need to dive in, and you need to be able to make a few mistakes and learn from them. And, like Keith said, the key is to have, your money, a tenant's money, the bank's money, all working for you and creating wealth and creating income streams. It's not just about using your savings in some 401k. That's only a tiny part of the picture. And with properties, you have your own money, tenants' money, banks' money, all working with you, all working towards, inflating assets and putting income streams into your pocket. So, bear that in mind, just something to mull over, something to think about, I guess. And, that's more or less it from me. Check out that website if you haven't yet, colininvestments.com. Do leave me a note or a review or a 5-star rating if you're enjoying these. I'd really appreciate it. Or even better, if you want to share them with your friends on social media, if you think other people might get something out of this show, that would be a huge favor to me. I'd certainly appreciate that as well. And just don't feel free to reach out and talk to me, or make suggestions for future shows or other things you'd like to see on my website. I'm very, very open to that. I'm having fun doing them. And I'll be back again next week with another great guest for episode 20. But for today, this is me, Colin G. Murphy. I'm signing out. Everybody have a fantastic day, a fantastic weekend, whatever you got going ahead of you. All right, bye-bye. Take care.